All right, it's November 6th. The market is stuck, plain and simple. We've got the Fed on one side trying to be dovish and some really ugly technicals on the other. The next 2 weeks are going to be a battle for control. So let's get right to it. Let's break down the key levels that are going to define this next major move.
So, that rally we got after the Fed rate cut, yeah, it's pretty much faded, and it's pulled the indices right back down to some critical support levels. The battle lines are drawn. Now, the big question for all of us is this just a healthy pullback, a little consolidation, or is this the start of a serious breakdown? The levels we're about to cover, they're going to give us the answer. Okay, market at an inflection point. Look, there are two huge forces at play right now. First, we're seeing this massive rotation under the surface. Money is flying out of growth into value. And second, the major indices are at these make or break support levels. So let's dig into the data. And you can see the divergence right here. It's crystal clear. Capital is just gushing out of last month's darlings, the NASDAQ, and it's flowing into cyclicals like transports. I mean, this is textbook late cycle behavior. It's a huge signal that risk appetite is changing, shifting away from those high growth names and into value. So because of this rotation, the major indices have been dragged right down to their key short-term trend lines. We're talking the 20-day moving average for the S&P and the NASDAQ, and the 50-day for the Russell. Now, for the bulls, holding these levels is, well, it's non-negotiable. If these levels fail, the door is wide open for a much, much deeper correction. All right, so what's the bull case from here? Why should we be optimistic? Well, it's really built on two powerful pillars: the promise of more easy money from the Fed and a really strong historical tailwind from seasonality. And listen, the market isn't just hoping for more easing. It is pricing it in as a near certainty. I mean, look at this. The CME FedWatch tool is showing a 93.5% probability of another rate cut by January. That expectation of cheaper money, that's a huge backstop for stock prices. And then you've got the seasonal force. After the NASDAQ has a 7-month winning streak, which it just did, historical data shows a staggering 95% probability of a positive return for November and December. You know why? It's usually driven by fund managers. They're chasing performance, trying to pretty up their books before the year ends. But on the other side of the coin, we have the bear case. And honestly, it's just as compelling. It's all based on a cluster of technical warnings and some really clear signs of fragility just under the market's surface. So a cluster of Hindenburg Omens has been triggered recently. Now, let's be clear, this is not a crystal ball, but it is a very serious statistical warning. What this thing does is it measures the internal health of the market, and it triggers when you get a weird situation where you have a lot of stocks hitting new highs and a lot of stocks hitting new lows at the same time. It's a sign of a deep fracture, a market that's pulling itself apart. Historically, it's a major red flag that the conditions are ripe for a big decline. And it's not just the technicals. Sentiment is confirming the warning. I mean, look at this quote. In just 1 month, we've swung all the way from greed to extreme fear. That's a massive shift. It tells you that traders are actively de-risking. They're getting defensive, and they've become super sensitive to any bad news. And here's the proof of that sensitivity right here. The market is showing zero tolerance. I mean, look at these names: Duo, ELF, FTNT, all of them just hammered. And not for their current results, but for their forward guidance, their outlook. Even strong reports from giants like Palantir and AMD got sold off. So here's the takeaway, and this is crucial. The market has flipped from a buy the dip mentality to sell the news. Good news just isn't good enough anymore. Okay, before we get to the levels and setups, the mandatory disclaimer: this content is for educational purposes only. We're aggregating public sources to help you stay informed and sharpen your own decision-making. Please do your own research. This is not financial advice. And hey, if this analysis is helping you make sense of things, please take a second to like and subscribe. It really does signal the algorithm and helps us reach more viewers. Your support is really appreciated. All right. The deciding levels. So we've got this clear conflict, right? Bullish macro drivers versus bearish internals. The tiebreaker, the thing that decides who wins, as always, it's going to be price. So let's get to the objective levels that will resolve this whole thing. Okay, these are the lines in the sand. For the S&P 500, support is that 20-day moving average right around 67.50. A break below that, and we're likely looking at a much deeper drop. To the upside, resistance is the 65.50 call wall. That's just a level with a huge amount of call options sitting there. A break above that could trigger a big squeeze higher. For the NASDAQ, it's a simple test of its 20-day. And the Russell, it absolutely must hold its 50-day at 241. Honestly, the price action right here at these levels is the only signal that matters now. Okay, risk-defined options setups. Now, given all this uncertainty, let's look at a couple of potential option setups that offer defined risk based on everything we've just talked about. All right, setup number 1 is in Tesla. This is a volatility play on a breakout. It's a high beta name, and it just looks coiled for a potentially explosive move, all driven by a potential gamma squeeze. So the thesis here is all about positioning for a gamma squeeze. Why? Because there is a massive wall of call option open interest sitting between $465 and $470. If we get a strong break above that zone, dealers who sold those calls will be forced to buy shares to hedge themselves, and that can pour fuel on the fire, accelerating the rally. A debit call spread is one way to play this with defined risk. The whole idea is invalid, of course, if the stock fails to break out or if it breaks down through near-term support. Okay, setup number 2. Google. This is a relative strength play on a pullback. Google has been a clear market leader, showing a ton of strength. The strategy here is to use this current market weakness as a chance to get in at a better price. Look, Google has been outperforming its peers, period. So for anyone looking to own a high-quality name, selling a cash-secured put or a put credit spread down in that $255 to $265 support zone is a strategy to consider. It lets you either acquire the shares at a discount to where they are now, or you just collect the premium if the stock holds that support. The main risk, of course, is that you get assigned the shares, and the thesis is dead if that support zone breaks in a meaningful way. And now, another mandatory and very important warning. Options involve substantial risk and are not suitable for every investor. All of your capital is at risk. With certain strategies, your losses can exceed the premium you paid. This is not a trade recommendation. Always use strict position sizing and risk management discipline. All right, let's put it all together. The final thesis. The market is at a crystal clear inflection point. It's being pulled in two directions by powerful bullish seasonality on one side and some increasingly loud bearish technical warnings on the other. So the question for the next couple of weeks is really simple. Is this just a healthy pullback that's setting the stage for a big year-end rally? Or is it the start of something much worse, a significant bearish breakdown? My advice? Forget the narratives, forget all the noise. The price action at the key support levels we just defined, that's what's going to give us the objective answer. And one last time, this is not trading advice. It's just a market update to help keep you informed. All markets carry risk. Make sure you trade your own plan, you manage your downside, and you always verify all data for yourself. Stay safe out there.